Well, hello there, my fellow financial freedom fighters. Rick Sullivan here with another episode of NASDAQ Weekly. Today, we're about to talk about the great AI stock reality check of 2025. Let me tell you something right off the bat. If you're one of those people who threw money at anything with AI in the name back in 2023, thinking you discovered some magical money printing machine, well, you're about to get a harsh lesson in how markets actually work. Once again, it's the little guy getting left holding the bag while the big money players knew exactly when to get out. Back in 2023 and early 2024, you couldn't swing a dead cat without hitting an AI stock that was supposedly going to the moon. Every company with a website and a chatbot was suddenly an AI company. Stock prices went parabolic. Retail investors, that's you and me folks, were pouring their life savings into anything that mentioned artificial intelligence. But now something interesting has happened. The market grew a brain. Suddenly, investors started asking uncomfortable questions like, hey, are you actually making any money from this AI stuff? And wouldn't you know it, most of these companies had to shuffle their feet and mumble something about future potential. Now, I want to be clear here, AI is real. This isn't some crypto nonsense or NFT scam. Artificial intelligence is genuinely transformative technology that's going to reshape our economy. But just because the technology is revolutionary doesn't mean every company touching it is going to be a winner. Let's start with the obvious elephant in the room, Nvidia. Jensen Huang's little chip company has basically become the arms dealer of the AI revolution, and boy, are they making a killing. Their latest quarter showed revenue hitting almost $47 billion, up 56% year over year. Their gross margins are sitting pretty at over 70%. Which in plain English means they're printing money faster than the Federal Reserve. This perfectly illustrates how our economic system works. Nvidia has what economists call a moat. They've built this ecosystem around their chips that makes it incredibly hard for customers to switch to competitors. I'm not saying Nvidia is a bad company, they're actually incredibly innovative. But their dominance, their near monopoly in AI training chips, tells us something uncomfortable about how capitalism really works. When you control a critical resource that everyone needs, you can basically name your price. Sound familiar? It should, because that's exactly how oil companies, pharmaceutical companies, and telecoms operate. Meanwhile, let's talk about the companies that are getting squeezed. Take AMD, Nvidia's supposed main competitor. They posted record revenue of about $7.5 billion, which sounds great until you realize their data center growth was only 14% compared to Nvidia's explosive numbers. The market basically yawned at AMD's results. Why? Because in our winner-take-all economy, being second place often means being irrelevant. What really pisses me off is that we've created an economic system where innovation gets rewarded, which is good, but where that reward becomes so concentrated that it creates these massive inequalities. Nvidia's success is built on decades of public research funding, public university education for their engineers, and public infrastructure. But when the profits roll in, somehow it all becomes private gain. But let's get back to your portfolios because that's why you're here. The downstream players in the AI supply chain are getting absolutely hammered, and it's a perfect case study in how supply chains really work in modern capitalism. Look at Dell Technologies. They had what should have been a celebration, record revenue of almost $30 billion, up 19% year over year, driven by massive demand for AI servers. Their servers and networking division grew 69%. In any rational world, that would be fantastic news, but their stock fell 10% on the announcement. Why? Because their gross margins got squeezed down to about 18.5%. See, Dell is stuck in the middle. They need Nvidia's expensive chips to build their servers, but their customers are getting pickier about prices. So, Dell gets to play the fun game of paying premium prices for components while competing on razor-thin margins for the final product. It's even worse for a company like Supermicro Computer. These guys became the poster child for the AI hardware boom. Their stock went up over 200% at one point because they specialize in assembling AI servers. But then reality hit like a freight train. Their latest quarter showed gross margins collapsing to less than 10%, barely better than a grocery store. What happened? Simple economics. When demand outstrips supply, everyone makes money. But as the market matures, it becomes a commodity business. Customers start shopping around, comparing prices, demanding better deals. The companies with unique, hard-to-replace technology like Nvidia keep their fat margins. The companies that are basically assembling other people's parts get squeezed until they're barely profitable. This is Capitalism 101, and it's playing out in real time in the AI sector. The value accumulates at the top of the food chain, with the companies that control the critical intellectual property. Everyone else fights for scraps. For now, they're still pumping out articles about AI opportunities and the next Nvidia, but they're missing the bigger picture. The era of easy AI gains is over, done, finished. If you were hoping to throw some money at random AI stocks and retire early, that ship has sailed. The market has gotten selective and it's rewarding actual results over flashy promises. But nobody's talking about the human cost. When Nvidia's stock price goes up, that's great for Nvidia shareholders. But what about the workers at companies like Supermicro who are seeing their stock options become worthless? What about the small suppliers who took on debt to expand their capacity for AI components, only to find themselves in a price war? This is the dark side of creative destruction that economists love to talk about. Yes, AI is creating incredible value and efficiency gains. But that value isn't being distributed evenly. It's flowing to capital owners, not workers. It's flowing to companies with pricing power, not competitive industries. And speaking of competition, let's talk about the global dynamics here. The AI revolution isn't happening in a vacuum. There's this whole backdrop of increasing tension between the US and China, and that's creating some wild distortions in the market. The US government has been trying to cut China off from advanced AI chips, thinking they can slow down China's AI development. But anyone with half a brain could see this was going to backfire. When you tell someone they can't have something, they figure out how to make it themselves. China is now pouring massive resources into developing their own AI chips, and they're making real progress. Huawei, despite all the sanctions, has managed to capture 46% of China's domestic AI chip market. They're benchmarking their new chips against Nvidia's best offerings. Alibaba and Baidu are developing their own AI chips. We're talking economic independence. We're essentially splitting the global technology ecosystem into two incompatible camps. Instead of having one global market where the best technology wins, we're creating a bifurcated world where American companies can't sell to Chinese customers and Chinese companies can't access American technology. This is incredibly inefficient from an economic perspective, but it's politically necessary because both governments are playing zero-sum games. The problem is that innovation thrives on openness and collaboration. When you start building walls, you slow down progress for everyone. Meanwhile, Europe is trying to find a third way with their AI Act, focusing on regulation and ethical AI development. Which sounds nice in theory, but in practice it might just mean European companies fall further behind in the global AI race. Sometimes being the most ethical player in a ruthless game just means you lose. Now, for your investment strategy, the research I've been looking at suggests we need to completely rethink how we approach AI investing. Forget about the broad AI basket approach. Those days are over. The market is now separating winners from losers based on actual fundamentals, not just AI exposure. If you're going to invest in this space, you need to be selective and focus on companies with real competitive advantages. Companies with economic moats like Nvidia are selling an entire ecosystem of software and tools that make it incredibly difficult for customers to switch. That ecosystem creates pricing power, which creates sustainable profit margins, which creates wealth for shareholders. So buy the winners and hold forever, right? Well, what happens when those winners become so dominant that they attract regulatory attention? What happens when their growth rates inevitably slow down because they've captured most of the available market? Nvidia's stock is trading at around 50 times earnings. That's not crazy by historical standards for a high-growth company, but it assumes they can maintain their torrid growth pace for years to come. If their growth slows down even a little bit, that stock could get hammered. I've got to be honest with you, stock market success is largely determined by access to information and capital. The big institutional investors, the hedge funds, the pension funds, they have teams of analysts, direct access to company management, and the need to move in and out of positions quickly. Retail investors like you and me are playing a different game entirely. When Nvidia reports earnings, the big money players already know what to expect because they've been talking to suppliers, customers, and industry experts for months. By the time the earnings report comes out, the information is already baked into the stock price. Retail investors are always playing catch up. This is why I get so frustrated with the standard investment advice of just buy and hold index funds. That advice assumes the market is efficient and fair, but it's neither. It's a system designed to extract wealth from individual investors and concentrate it in the hands of professional money managers. I'm not saying you shouldn't invest in AI stocks, but I am saying you need to be realistic about what you're up against. You're not competing on a level playing field, and pretending otherwise is just setting yourself up for disappointment. So, what should you do? First, if you're going to invest in AI, diversify across the entire value chain. Don't just buy chip stocks. Look at companies providing infrastructure, software, energy, and services. The AI revolution requires massive amounts of electricity, cooling, networking, and data storage. There are opportunities throughout the ecosystem. Second, pay attention to valuations. Just because a company is growing fast doesn't mean it's worth any price. Some of these AI stocks are priced for perfection, and perfection rarely happens in the real world. Finally, be prepared for volatility. Even the winners in this space are going to have their ups and downs. Nvidia has had several 20 to 30% pullbacks over the past 2 years despite its overall spectacular performance. If you can't handle that kind of volatility, maybe stick to more boring investments. This whole AI investment frenzy is another example of how our economy has become completely financialized. Instead of celebrating the fact that we're developing incredible new technologies that could solve real human problems, we're primarily focused on which stocks are going up. We're turning genuine innovation into a casino game, where the value of companies fluctuates wildly based on quarterly earnings reports and analyst predictions. Meanwhile, the actual work of developing and implementing AI technology becomes secondary to the stock price movements. This is exactly what happened during the dot-com boom. People got so focused on internet stock prices that they lost sight of the fact that the internet was actually a revolutionary technology that would genuinely transform society. The speculation became more important than the innovation. The really perverse part is that when the speculation gets out of hand and crashes, it actually slows down real innovation. Companies become more conservative about investing in new technology because they're worried about disappointing investors. Venture capitalists become more risk-averse. The whole ecosystem gets distorted by financial considerations. I've seen this pattern play out multiple times over my career, and it always frustrates the hell out of me. We have this incredible capacity for innovation and problem solving, but we keep getting sidetracked by get-rich-quick schemes and financial engineering. What might surprise you is some of the best ideas for organizing economic activity don't come from the free market at all. They come from public research institutions, government agencies, and collaborative networks that aren't primarily motivated by profit. The internet was developed by DARPA, a government agency. GPS was developed by the military. The touchscreen technology in your smartphone was developed at public universities. Even the basic research that led to AI breakthroughs happened largely in academic settings funded by public money. But somehow, when these technologies get commercialized, all the benefits flow to private companies and their shareholders. The public that funded the original research gets to pay market prices for the products that resulted from their own tax dollars. This is one of the biggest scams in modern capitalism, and nobody talks about it. We socialize the risks and costs of innovation, then privatize the profits. It's heads I win, tails you lose, played out on a massive scale. Now I know what some of you are thinking. Rick, that sounds dangerously close to socialism. Guys, the reason countries like Denmark, Sweden, and Germany have higher living standards and less inequality than us is because they haven't drunk as much of the free market Kool-Aid. Having a strong public sector that invests in research, education, and infrastructure actually creates more prosperity than leaving everything to private companies focused on quarterly profit maximization. So it's not a big stretch to say that worker protections and social safety nets actually make economies more dynamic and innovative, not less. I know these ideas make a lot of Americans uncomfortable because we've been programmed to think that any government involvement in the economy is the road to serfdom. But look at the results. Countries with stronger social democratic institutions tend to have higher productivity, better education systems, and more sustainable economic growth. The irony is that the AI revolution could actually make these more collaborative economic models easier to implement. When machines can do more of the routine work, we could have shorter work weeks, universal basic income, and more time for education, creativity, and innovation. Instead, we're using AI to make rich people richer while everyone else worries about getting replaced by robots. But let me get back to practical investment advice. If you're going to navigate the AI investment landscape successfully, you need to understand the political and economic forces at play. The US government is going to continue trying to maintain technological dominance over China, which means more export controls, more restrictions on technology transfers, and more pressure on American companies to decouple from Chinese supply chains. This creates both risks and opportunities. Companies that are heavily dependent on Chinese manufacturing or Chinese customers are going to face ongoing uncertainty. But companies that can help American businesses reduce their dependence on China might benefit from government support and policy tailwinds. The infrastructure demands of AI are staggering. Data centers are using enormous amounts of electricity, and that demand is only going to grow. This creates opportunities in energy, utilities, cooling systems, and grid infrastructure. These might not be as sexy as chip stocks, but they could be more stable and predictable investments. There's also the software and services angle that I think gets underappreciated. Yes, the hardware is important, but the real value in AI comes from applications that solve real business problems. Companies that can successfully integrate AI into existing workflows and deliver measurable productivity improvements are going to do very well. My biggest concern about AI investing is that if we're headed for another bubble, which is quite likely, when it pops, it's going to hurt a lot of regular investors who got caught up in the hype. The parallels to the dot-com boom are getting stronger every day. Sky-high valuations based on future potential rather than current earnings. Massive speculation in companies with no clear path to profitability. Institutional investors getting nervous while retail investors keep buying the dip. The difference this time is that some of the leading AI companies actually are profitable and have real business models. Nvidia, Microsoft, Google, Apple, these are not dot-com era startups burning through venture capital with no revenue. But that doesn't mean their stock prices can't get way ahead of reality. Even good companies can become overvalued. And when sentiment shifts, even the best stocks can get cut in half or worse. So don't bet everything on AI stocks, no matter how convinced you are that artificial intelligence is the future. Diversify across different sectors and geographies. Keep some cash on the sidelines in case opportunities emerge during market dislocations. And please, for the love of all that's holy, don't take investment advice from social media influencers or day trading gurus on YouTube. The AI space is complex and rapidly evolving. If you're going to invest in it, do your homework, read company financial statements, understand the competitive dynamics, know what you're buying and why. One more thing I want to mention. The social implications of the AI revolution are going to be massive, and they're going to affect investment returns in ways that most people aren't thinking about. When AI starts displacing large numbers of workers, that's going to create political pressure for policies like universal basic income, higher taxes on capital gains, and stronger worker protections. These policies might be necessary from a social stability perspective, but they could also affect corporate profit margins and investment returns. Similarly, as AI becomes more powerful and ubiquitous, there's going to be increasing pressure for regulation around privacy, safety, and market concentration. Some of the dominant AI companies today might find themselves facing antitrust action or being forced to break up. These are the kinds of long-term risks that don't show up in quarterly earnings reports but could dramatically affect the investment landscape over the next decade. Alright folks, I think I've given you plenty to think about today. The AI revolution is real, it's transformative, and it's creating both tremendous opportunities and serious risks for investors. The companies that can execute and deliver real value are going to do incredibly well. The ones that are just riding the hype are going to get hammered. From here on out, we need genuine analysis, careful selection, and strong risk management to succeed in this space. But for investors who do their homework and stay disciplined, there are still fortunes to be made. That's all for today's episode of NASDAQ Weekly Podcast. Keep fighting the good fight, keep asking the tough questions, and never let the bastards wear you down. Until next time, this is Rick Sullivan signing off. Remember folks, if you enjoyed today's episode, subscribe to the NASDAQ newsletter where I break down the markets without the Wall Street spin. And if you really want to stick it to the man, share this podcast with someone who needs to hear it. Knowledge is power, and power should belong to the people, not just the privileged few.